We continue with the fourth video. Now we are looking at the consolidated profit and loss account. Pay a lot of attention. The consolidated P&L is slightly different from the balance sheet. That's what makes it more highly examined. The sales, we get 100% for the parent. But when it comes to the subsidiary, we time a portion. You only consolidate the sales for the number of months that you had the subsidiary. So if you had the subsidiary for 2 months, you only get sales for 2 months. If you had the subsidiary for 11 months, you only get sales for 11 months. Then for the adjustments, you subtract all the intra-company sales. All the intra-company sales you subtract. There's nothing like you have sold some of the goods. It doesn't matter whether some of the goods have left the group or not. Whatever was sold is subtracted from the sales. To give you your total sales. Then you go to the cost of sales. Again, you get 100% for the parent. You time a portion for the subsidiary. Now, you only time a portion if you had the subsidiary for less than 12 months. If you had the subsidiary for more than 12 months, you are going to consolidate 100% of both the sales and the cost of sales. But at this level, it's extremely rare to find a question where you had a subsidiary for more than 12 months. That one is tested at F3. At this level, you are guaranteed 99.9% of the questions will be time apportioning. So that when you go to P2 will be consolidating 2 subsidiaries. One subsidiary will be 100%, the other one will be time apportioning. So that's the way the examiner tends to test these 3 papers in terms of consolidation. The same figure that you took out under intra-company sales is the same figure you're going to take out under cost of sales. So under cost of sales, you're going to subtract intra-company cost of sales. One will have recorded a sale, one will have recorded a cost of sale. If I sell to you Nampasa, say I sell to you a packet of sugar at 20 kwacha, I'll record 20 kwacha as my sale, you record 20 kwacha as your cost. So the same figure should come out from the sales and the cost of sales. Now the cost of sales has got another addition, another adjustment. You add the unrealized profit to the cost of sales. The unrealized profit, which we know by now as being the profit for those goods which are still in stock, is added back to the cost of sales. Then you close the cost of sales, you subtract the total sales minus the total cost of sales to give you your gross profit figure. Once you are done with those calculations, the rest of the calculations which will come after gross profit will be 100% parent and time apportion subsidiary. So it will just be like that all the way down until you finish consolidating your profit and loss account. Line by line, you'll be consolidating 100% parent, time apportion subsidiary, the expenses, the tax. The only thing that you're not going to time apportion, the question will be very specific for any transaction which has just happened within the whole of the transaction has happened within that particular period. But those items which you are given in the balance sheet, those you time apportion. Once you are done with time apportioning, then you close and get your net profit. Any question from there before we try and wrap it up?
Just can you repeat on the ones that do not need time apportion?
Anything below gross profit or the items that you'll be given in the question under gross profit, you'll be getting 100% for the parent, you'll be time apportioning for the subsidiary. There may be one or two, usually just about one item, which will be, you're going to always find it in the notes, which you may not need to time apportion because it would have happened just within that period in which you are consolidating. But everything in the income statement will have to be time apportioned. Again, remember, if you've had the subsidiary for more than 12 months, then you'll be consolidating 100%. But like I've said, the 100% consolidation in the P&L is done at F3, at F7, extremely rare. I can't even remember ever coming across a question where you consolidate the P&L 100%. If there's no question, then I'll switch the screen. We are done with. I wanted you to have a visual of how you'll be consolidating. Any question? Do you need to take some screenshots of these sketches on consolidation? Or you are taking them down as we are going?
Screenshots would be okay.
Okay, you can start with that one. Now, as long as there's that relationship of parent and subsidiary, you are required to prepare consolidated financial statements. It's compulsory. There is no any exception where a parent can avoid preparing the consolidated statement of financial position. Remember this. You will find multiple choice questions where they give some reasons why a parent should not consolidate. There is no reason. The standard is strict on this one. As long as there is that parent-subsidiary relationship, you are required to prepare the consolidated financial statements. On the other hand, if a member of the group does not use the same accounting policies as used in the consolidated financial statements, you need to adjust. These have to be adjusted so that they align to the parent's accounting policies. I'll repeat that one. If a member of the group does not use the same accounting policies as used in the consolidated financial statements, the consolidation adjustment must be made to align to the consolidated financial statements. So the subsidiaries' accounting policies should be adjusted so that they align to those of the parent. So, where possible, the financial statements of the parent and those of the subsidiary should be prepared to the same reporting date so that it makes it easy for the consolidation process. But where this is impracticable, the most recent financial statements of the subsidiary can be used, providing the difference between the year end is no more than 3 months. I will repeat that. Where this is impracticable, the most recent financial statements of the subsidiary can be used, providing the difference between the year ends is no more than 3 months. Also, adjustments are made for the effect of significant transactions or events that occur in the intervening periods. So any significant transactions or events must be adjusted for. And lastly, the length of the reporting periods and any difference between the dates of the financial statements is the same from period to period. So we have come to the end of consolidated financial statements. Next, we'll be looking at questions in the ref kit. So please go through this topic. Those proformas I gave you, starting from the proforma for goodwill, the proforma for the consolidated retained earnings, the proforma for the non-controlling interest, the proforma for the consolidated balance sheet, and the consolidated profit and loss. You need to memorize those. They are extremely important. Now when it comes to the consolidated balance sheet, they may ask you just individual entries within the balance sheet, how individual entries are done. So they may ask you, just even in a multiple choice question, how you are going to calculate the total inventory in the consolidation. They may ask you how you are going to get the total sales figure which you bring in the consolidation, just as one line item. They may not ask you to prepare the whole financial statements. So please memorize all those 5 proformas. They are extremely important. Any question before we